Legendary investor Warren Buffett managed to turn thousands of dollars into billions without tech startups, risky speculation, or beginner's luck. He may be nicknamed the Oracle of Omaha, but he is no superhero, nor did he win the lottery. He is successful because he is disciplined, patient, and uses common sense. In this video, I will show you 7 rules and characteristics that helped Warren Buffett achieve such great success. At least the last rule is not followed by many investors, and they lose money because of it. Whether we are just starting to invest or have been investing for some time, it's not about getting rich quick, but rather about persevering, following the basic rules, and building our wealth in the long term. But I won't keep you waiting any longer, so sit back, relax, and let's get started. For those who don't know Warren Buffett yet, or have only heard a little about him, he is one of the most successful investors of all time. He was born in 1930 and already as a child had an entrepreneurial spirit, delivering newspapers, running a small lemonade vending machine, and so on. First shares. At the age of 11 in 1942, he gradually gained experience until he built one of the largest insurance and investment companies in the world. Today, he is still the CEO and majority shareholder of Berkshire Hathaway, which he transformed from a declining textile company into an investment conglomerate and is now the 10th largest company in the world. During his lifetime, he has built up a fortune of over $100 billion, mostly by investing in simple and easy to understand companies. He did not become rich overnight, but worked hard from an early age and devoted himself to investing in building companies. And thanks to his long-term approach, he has managed to build up the fortune he has today. But despite his enormous wealth, he still lives quite modestly. He lives in a house he bought in 1958 and drives an ordinary car, a 2014 Cadillac, but he used to drive an old Toyota. Buffett is best known for consistently outperforming the S&P 500 index. Specifically, since 1965, his Berkshire Hathaway has earned investors 20% per year compared to the 10% return brought by the market average in the form of the S&P 500 index. Of course, with growing assets, the ability to outperform the market declines, and over the last 10 or 15 years, Buffett has had a similar return to the S&P 500, but he is invested in more stable and defensive companies, and is also less volatile overall than the S&P 500 index. But let's take a look at Warren Buffett's rules and characteristics and what led him to such success. This certainly does not mean that if we follow them all, we will earn 20% a year and become Buffett number 2 in our old age, definitely not, but it can greatly help us on our investment journey. And the first very important rule is patience and long-term thinking. Buffett does not invest for quick profits. His strategy is simple: buy a quality company and hold it for decades. One of his famous quotes is, "My favorite holding period is forever." Simply no day trading, no gambling with stocks for the short term. He doesn't chase short-term profits, but long-term gains. This requires discipline and investing in stocks in which he believes in the long term. He does not get carried away by short-term trends or negative sentiment. If he's done a thorough analysis of a given company, he will persevere despite any short-term downturns and times when the company is not doing so well. When it comes to choosing companies that Warren Buffett owns and has invested in, almost all of them share one very important characteristic. Buffett avoids unnecessarily complex products and investments that he does not understand. He prefers to invest in companies that have a simple and understandable business model. Whether it's the well-known Coca-Cola, ketchup manufacturer Kraft Heinz, or companies in the financial sector such as Bank of America or American Express, or even his largest position, Apple. While the smartphone itself is certainly not simple to manufacture, the business itself is ultimately easy to explain. The sale of overpriced phones and other hardware and related services. Buffett also buys companies that are likely to still be around in several decades, have a strong brand, and are not at risk of being replaced by another company. But Warren Buffett didn't know all this from birth, and he didn't learn it in school. His education certainly didn't end there. On the contrary, he continues to educate himself throughout his life, learning about new businesses, how their fields work, what their specifics are, and so on. It is necessary to be open to new information and, in general, to have a desire to learn new things and move forward. And for me, one of the most important rules for us as long-term investors is to keep our emotions in check. It's not exactly a pleasant feeling when stock markets crash, and for example, our million suddenly becomes only 0.5 million after a 50% drop. However, it is necessary to keep a cool head as much as possible, buy more during downturns, and sooner or later, the stock markets will bounce back. At least that's how it's been for the last 150 years, and it will probably continue to be so. Buffett was certainly helped in maintaining his earned wealth by not spending money on unnecessary things. This means that despite his enormous wealth, he still lives quite modestly. He lives in a house he bought in 1958 and drives an ordinary car, a 2014 Cadillac. No yachts, private islands, private jets, or similar nonsense. He spends where it makes sense to live happily and contentedly. And thanks to that, he has more left over to invest and expand his wealth. One of his most famous pieces of investment advice, which basically sums up the idea of buying when investors are panicking and prices are low, and conversely being cautious when euphoria reigns and prices are high. Be fearful when others are greedy, and be greedy when others are fearful. This paid off, for example, during the tech bubble at the end of the 1990s when stocks rose by tens of percent annually, but Buffett did not jump on the tech bandwagon, and although he had a worse valuation for a while, when the bubble burst and stocks fell by tens of percent, Buffett started buying and outperformed other investors. He is often not afraid to invest against the trend. Okay, but what can we take away from all this? Warren Buffett is not a superhero. He did not win the lottery, nor did he have any secret information. But he is successful because he is disciplined, patient, and has common sense. And these qualities can be developed and maintained by each of us. We may not end up with a 20% annual return, but that doesn't matter. Keep learning, and above all, stay calm. Panic and rash decisions are an investor's worst enemy. When investing in individual stocks, try to understand the business and know what you are investing in, and invest in companies with strong brands that are likely to be around for decades to come. And what about you? Which of Buffett's rules do you find most important, and which ones are you not following yet? Post your insights and answers in the comments below. Thanks a lot, and see you soon.